Hello and welcome to another Xero How To, where we're going to look at utilizing tracking codes. So looking at the creative ways that we could be applying these within our practice. So I'm just going to change screens so you guys can see our Xero demo company, and we're going to look at the tracking code element within here. So just at principle, I'm going to hide this little banner so it's not blocking the screen. So first things first, where do we find tracking codes? We find these under accounting and advanced. And we have our tracking categories on the right hand side here. You can favorite this, but at the moment I've set up some tracking categories. Now we only have the option for 2 main headers, but within each of these we can have many fields. In fact, actually I don't think there's a limit on the amount of fields we can have in these ones.
There's not a limit in the number of fields that you can create, but if you're exporting reports or if you're using reporting tools like Spotlight or Futurely, you can only export 50, and that's where it starts to get messy. So if you've got multiple tracking codes and you're looking at a P&L in Xero, it also gets too long and it becomes unmanageable. So use them carefully but considerately. So you need to think about what you want to use tracking codes for and why you need them.
Mind you, there are workarounds for those, so it depends what you need. But what I would say is start off, and we're going to show you a few examples. So the first example we're going to show you is how to apply it to monitor your margins. So I've got a profit and loss set up, and what I've done is I've gone into my profit and loss, I've changed the compare periods, and what I've done is down here there was a little more options tab. If you select on this, you can then see what various filters you can apply. And in particular, these are my tracking categories down here. So I've applied all of my margin examples down here. And then I've simply selected update. So what I have here is my various project analysis. So I can see east, north, south, west, and unassigned. Unassigned is a really important column because basically it's saying if there's anything in here, we haven't actually assigned a sale or a cost to a given project.
Yeah, so it's almost as important as the rest of them, isn't it?
It's basically our control account.
Yeah.
So what we can see here is we can see the profitability of our underlying projects. But what's unusual in here is in our unassigned category, we actually have some unassigned purchases. So this would be an item we'd look at because in most instances, this may include a cost that possibly relates to one of these projects, might relate to more than one, but simply
or
by
a new project that hasn't started to be tracked yet.
There is also that as well. There might be a southeast going on somewhere which we haven't actually set up. Now, in most of these cases, we don't often see operating expenses assigned to a given project.
Not for projects. Well, it depends on how you manage your projects. If you're measuring margin, it's usually your sales less your cost of sales is your contribution to your overhead. There's not many companies nowadays that do, not the smaller companies, that look at the operating cost as attributable to a project. You can do if you want to, but it's an awful lot of effort. Generally, your overheads are fixed regardless of whether you're working on a project or not. So I would, for the most part, ignore those and just do your project tracking if you're looking at margins at the gross profit level.
Now, you can also use this for things like consultants, if you run a recruitment agency, and anything along those sort of lines where actually you need to monitor, say, a project's performance or a staff member's performance, you can actually use this.
Yeah, so projects could also be people, they could be buildings, they could be departments, they could be all sorts of things like that.
So that's a taster of how we could look at margins. Now, the next one we're going to look at is a control mechanism. So we're using tracking to control. And in particular, we're going to look at an example where we're looking at timings. So at the moment, I've loaded up September and I have filtered by a control example. So what I've done here is I've basically named my tracking codes based on months. So the reason I've used 09 and 10 is because it makes it look neat. They represent it in order when you're looking at your tracking category. You don't have to apply them, but we just find it a lot tidier when you do. And this is another little example of how you can lay it out. So at the moment I've got 09 September, but over here I've got 1907 July. It's up to you how detailed you want to be in your tracking codes. Now, if you apply the month and the year, which is what we're doing here, you basically end up with a longer P&L if you have periods that cross over.
Yeah.
So
it can get quite complicated then.
It can get fiddly. You need to update your tracking codes more regularly because obviously you have periods time out, whereas these ones are more future-proofed.
So the question is, why would you use months as tracking codes? And this is really good for those sorts of organisations. We have some clients that work like this, where they almost never have an invoice that's either raised out of the business or received by the business that actually relates to the month in which the invoice is dated. So if you think of a training example or training company, for example, this is very typical of training companies. They might raise an invoice in September, but it will relate to training in January, February, or March of next year. So this is a really easy way of identifying what costs are billed in one month but relate to a future month. And therefore, if you're going to defer them, accrue them, prepay them, you can use these tracking categories to be able to identify those costs. So in a training example, you might have your invoice raised for your sale in September. It relates to a course in January, February, March, but your costs might not come in until April. So March, November, or March or April time. And that's really typical. So you've got to accrue some costs, you've got to defer other costs to work out what the actual profit is for the trading activity of that month. So this is where this really comes into its own. And we use this a lot for clients who do have contracts that pass over the year or that are not raised in the time, in the months that they relate to.
Yeah. Now, like here we're looking at September, and we can see we've got September sales. So these are invoiced items dated within September, but actually the project relates to a October date. So straight away we know we've got something which is technically at this point in time sitting in the wrong month. So
you would defer that, and when you defer that sale and move that out into the correct month and rerun this profit and loss account, because of course you put the dates in the journal, that October column then becomes nil because that cost or that income in this case is not in that month. So this is a really useful way of managing those kinds of cost accruals.
Because all of a sudden our end result shouldn't be £11,000 worth of income sitting in September. It should actually be 3,900. So it's a really nice control mechanism.
Now, for my clients, I almost only ever use 09 September, 10 October. So I use the simplest date format, which future-proofs that time period. If you have clients that have costs or incomes that spread over a much longer period, you might find the year and the month more useful, but that will create some mess, like Harry was saying earlier.
Yeah. So let's look at another control mechanism we can use. So we might use tracking code as a cross-reference. So here's another example I have set up.
So what's the background behind this? Why would you use it for referencing?
Yeah, so let's do a little bit of background on this. So imagine I have an external system and I'm importing into Xero. So I might actually have a mismatch of perhaps naming conventions. I might change some of the billing entities in Xero, or I might have a unique field within the actual external system that I'm using. So I might have a customer reference as an example here. I might be using a customer reference which is BAS001 as a classic example. But actually the contact in Xero is, say, I can't remember the example for this, it might be basket case. So with this, if I'm going to check the system side by side, I all of a sudden have to check them line by line. It gets fiddly. So this is a way of basically saying, okay, all of basket case belongs to customer code BAS001. So all of a sudden, I can connect my invoices from Xero to my external system. So I can check like for like. So this is really handy to make sure that you've got all of the relevant sales and costs, etc. associated with a given contact. Now I'd mainly use this as a sales reference to make sure that we're pulling all of the data through correctly as we would expect. And if we see any differences, we'll soon know, because what we can do is check the external system, and if actually basket case has £1,500 worth of invoices, I straight away know I am missing something if I've got nothing in the unassigned category, because I don't have that for basket case, and I can check the other customers and make sure they match. So it's a really handy little tool, that.
And because all these numbers are blue hyperlinked, you can right click and open that in a new tab, can't you? And then you can have a look and trace those back.
Yeah. Now this is one of those ones that not every business may need, because if you're raising sales from Xero directly, you probably won't have a need for this because you won't have any systems to cross-reference. But it's handy if you've got CRM or if you've got another system which is importing data. Just means you can check them all and make sure they're all correct.
Yeah, we do have some clients that budget by client name, and if you're budgeting by client name, this again is a handy way of being able to check and cross-reference without having to worry about exporting all of the data and filtering it in a spreadsheet.
Yeah, because that can be fiddly, it can be manual, you can get errors, it's easily done. So what we like to do is set it up in the system, because then it's basically protected, it's future-proofed, and nothing changes unless we physically go in and change it ourselves, which is really handy because it means when one period is reconciled, you know straight away, you don't need to keep going back over that one, but you can check it really quickly if you need to. So it's nice and handy, and I do actually use this one in some large external systems.
I use the date ones on a monthly basis.
Yeah.
So it's really important to some of my clients.
But the underlying crux of the situation with tracking codes is
be
creative. So have a little think about what things might be useful. It might be actually you want to track margins, or perhaps you want to check something like you want to control something. So you want to actually make sure that your timings are correct. Or likewise, maybe you just want to cross-reference another system to make sure everything in Xero is as it should be. So just get some creative juices flowing on that one, because there's lots we can do. And you can even do two-way comparisons, so you can either filter by control and a margin as well if you need to. So do be creative with this and apply it within your business. I think it's quite a nice one. I use tracking codes a lot.
Yeah, so do I. More so than you originally expect to do, and they're so handy for so many different things. So as Harry says, be creative. If there's anything that you're doing in Xero where you think, I wish I could look at this in more detail, often that's where tracking codes come into play.
Yeah. And as I mentioned before, like when we mentioned that you can only export 50, one of the workarounds for that is, imagine this was my P&L and there was 50 odd transactions plus. One workaround is simply you highlight the data and you copy and paste it into Excel. So it can actually be done, even though you can't export it because it just trails off. You can literally copy and paste it. It does take a little while to load, but it's one of the workarounds.
Most of the time, I don't really have any issues with it exporting into Excel. It doesn't like to export into Google Drive sometimes, and it's exporting it into different systems like Spotlight and Futurely. It's the system-to-system export that it doesn't like, but spreadsheets generally okay.
Yep. So thank you very much for listening, and we hope you found this useful, and hope we're giving you some ideas of what you can use for tracking codes. If you have any questions or queries, please do let us know. And if you like this video, please do let us know in the comments.
Thank you very much.
Bye.